Ahoy there, me hearties. Good afternoon. Welcome to the live stream. It's FOMC day, baby. Things are about to get real interesting. So here in about 30 seconds, they are going to drop the FOMC minutes. What do we expect? We expect the market to move very far, very fast. Now, the initial move the market makes is generally not where it's going. So a lot of times what will happen is the market will, the FOMC minutes come out and the market starts to make a big move one way or the other, and then it retraces that move, in the subsequent 15 minutes or so. Okay, so here we go. We've just got those minutes released. Now we're getting ready for the market to start to move very fast, very far, and we're keeping in mind that the first move often gets retraced. It almost never starts a certain direction and then goes that way the rest of the day. So if you're trading in the direction of the move, you want to be locking in profits as quickly as possible. And if you're trying to take a trade once it reverses, you want to be trailing your stop as it works its way back. There is always door number C, and we have had this, if I were to say of the last 10 FOMC meetings, at least 5 of them, the market has gone literally nowhere. So is that a possibility? Yes, it is. But I don't think that's going to be the case today. I think the location of the market sitting here at all-time highs with so much weakness. Multiple unfilled gaps below, 2 of them on the ES, 3 of them on the NQ. I just think this market is begging to make a move. And then, by which I mean by the end of the day today. And that move will either be you start to squeeze sellers and you get another big push up, or you retrace some of this weakness, likely getting us down at least into the ballparks of 68.80 area. Okay. Potentially even 68.40 area. And that might seem impossible right now, but it's not. Once the market starts to move very quickly, it can just take out stops and really make a move. So for now, let's let the market absorb these FOMC minutes. As far as tempo is concerned, we tend to get this very fast tempo where the market is moving like this, just very, very quickly, up and down and up and down. We tend to get that for about 10 minutes or so. So between now and 2:10, we would expect this tempo of change to continue. And then it usually kind of slows down. It simmers down, 10 to 15 minutes into it. Then really nothing happens until 2:30. Once 2:30 comes, that's when Powell comes out and starts speaking. And generally, if the market is going to make a big move, it will do so when Powell starts speaking. And it'll be like, maybe it'll have a few fake outs, maybe it'll go up or down. Maybe it'll go up or down a few times, but then once it picks a direction and it starts to just keep going and going in that direction, that's where you can start to look for trades. And for those of you that don't know the way I trade FOMCs, I call it the butt cheeks trade. It's very simple. You cannot know when this market is moving a mile a minute, up and down and up and down. You cannot know where it's going to reverse, when it's going to reverse. So there's no way to choose where to put your stop. If you try to say, I'm just going to enter and have a 30-point stop, guess what it's going to do? Move straight down 30 points, take out your stop, and then turn around and come back up. And it'll happen to you every single time. It'll drive you nuts. So if you're going to enter a trade during FOMC, this is just from my experience, the only thing that works. And if you haven't done this before, you definitely don't want to do this with real money. You want to be paper trading today. But the best way to do it is to just get long or short at market and then wait about 30 seconds and just squeeze your butt cheeks real tight and just pray that you are right about the direction, because you can get long and then the next 30 seconds it goes down and you got a 20-point move that the market has just gone against you, and that's extremely painful. But the goal is you just enter at market, whichever direction you think it's going to keep going. Give it literally just a few seconds to get that momentum going, and then as soon as you can, move your stop above your entry. And what will happen is you'll get stopped out a lot, right? The market will be doing its thing and you'll go long and it'll stop you out, and then you'll go long and then it'll stop you out and then you'll go long. But if you can just catch one where you don't get stopped out and the market keeps going and going and going and going, I mean, you can literally make more money in a day than you've made in the last month. And that really is the simplicity of the system of the butt cheeks trade, is that you get in, whenever you feel confident, for whatever reason you feel confident. In my case, that would be after Powell starts to speak and the market has sort of picked a direction. Then I'll start taking trades in that direction, and just always move your stop above your entry as quickly as you can. If you guys have any questions for me, let me know in the chat. We got 79 people hanging out. Let's see if we can get all 79 of you to smash that thumbs up button. Get that like going. And then see if that doesn't lead to bringing some more traders our way. Okay, so right now the market is picking that first directional move, which is down. Remember, it almost always retraces that. Okay? How far down can it go? I do not know. When will it flip in reverse? I do not know, but there's a high probability it will. Let's just take a moment to look at the options. What's going on with the options market right now? So if you don't know what you're looking at here on the screen, this is the trace chart that comes from Spot Gamma, and it's basically showing us the SPX and what is happening with options on the SPX. The colors that you're seeing, those are the delta pressure. And the way to read it essentially right now is the purple above is resistance, the red below is support. So that's kind of compressing. Let's take a look at the overall gamma here. Ooh, overall gamma is getting a little red. So red gamma implies negative gamma. That implies that market makers will be trading with the move as opposed to against it. So if the market were to start going up into the red, the market makers are going to be going long as the market continues to go up. Or if it were to get down here and be going down into the red, the market makers would be going short into that. Whereas when it's more of a purple color, then that's going to be an area where they're going to be going against it. That's overall gamma, and then it's the same idea with delta pressure. What's chop got to do with it? Paul in the house, he says, here we are. Sometimes the anticipation is the best part, or especially as you get older. I don't know. I have no idea what you're talking about. But yes, if you're anticipating something, it's probably not going to come till 2:30 because this is a pretty boring start to FOMC. Bill in the house, good afternoon to you. Trevor is here. Welcome, welcome. And Paul says he liked the photo I had of Jerome Powell. Yeah, I've been using that one for a long time. The man looks terrified, which is how I feel every time he comes out to speak. Will in the house, hello to you. Jay is here. Buckle up. Bob for short. Howdy, howdy. Zero to Infinity says, how do you control your initial risk if there is no stop? The answer is there is no controlling the initial risk. You know, that is why the butt cheeks trade is gambling, plain and simple. There's no two ways about it. It is gambling. I've just never been able to find a way. And I did experiment for years with this. Like for years, every FOMC meeting, I would turn off my live trading account. I would open up a paper trading account and I would try a different strategy each time. And I tried them all, right? I tried trading with tight stops. I tried trading with loose stops. I tried going long and short at the same time. So I would like go long 10 MES contracts, short 1 ES contract. and then try to see if the market starts to make a move one direction, I can take profit on one and then wait for it to reverse on the other. I mean, I literally tried everything you can think of for trading FOMC. And the only thing that actually worked was the butt cheeks trade that I just described to you. The downside to it is, and this does happen, you can say you get long, and then at that exact moment that you hit the market buy button, the market could sell off 20, 30, 40 points on you, and you just have to exit right away. You have to be like, oh shit, it's not working, and get out. And you just have to eat that loss. So that's why I tell people, never do that with real money if you haven't done it a bunch of times first. Before anyone is trading FOMC with real money, they should have done at least 5 or 6 FOMC meetings on paper, to have practiced doing this, to know what it feels like, to know how to enter and how to adjust if the trade isn't working. Because it's not even just the being wrong and having to get out. Sometimes you can be right. Let's say you get long and the market starts to pump and pump and pump, and you literally can't get your stop in fast enough. Like maybe your broker is sometimes certain brokers and stuff like that, they can freeze up during FOMC. Certain platforms that you enter trades on can freeze up during FOMC. And that's fucking terrifying. If you get into the long, the market starts to move and you're like, oh my God, and it won't fill, won't let you move your orders around. And suddenly you start getting an indicator that didn't work, and you're just like, fuck. So all of that needs to be practiced. And you need to get good at it, and you need to feel comfortable with it before you trade it in real life. But once you do, I'm telling you, I've had some excellent days from FOMC, because if you get lucky, you get in, you get stopped out, you get in, you get stopped out, you get in, you get stopped out, you get in, you don't get stopped out, and boop, 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 boop. It goes straight to the moon, and then you make, 40 points in 5 minutes. Is it gambling? Yes, it is. Candle Swinger, welcome. He says, hi, y'all. Crypto Rider in the house. Good afternoon to you. Candle Swinger says, welcome to Tradeovate. That is one platform I'm talking about. Yeah, there are certain platforms that freeze up during these events. And so you don't want to be risking real money unless you know that ahead of time. Rich says, I love it. You have to practice freaking out. Yes, you do. You absolutely do. When you join the military and you go through basic training, they make you go through obstacle courses. And while you're going through the obstacle course, they are shooting guns and exploding things and making all this crazy noise all around you. Why? Because you have to practice, going through that course, doing whatever it is you need to get done in that moment under fire. Right? You got to practice the emotion of the fear and the panic and the uncertainty and the way your brain gets very cloudy very quickly. And it's hard to make good critical decisions. But if you practice it enough, when you're in the real shit, you can handle it. Okay, I would say it's too early to make an official call, but looking at the hero line from 2 p.m., it does look like it's starting to build momentum lower. So nothing to do with that yet, but I'm just going to keep an eye on that. That hero line is indicating the way options assume the market is going to flow. So if it's pointing down, that means that people that are entering option trades right now are assuming the market's going down. That's a fun one. Beginning December 1st, we will reinvest all mortgage-backed securities principal payments into treasury bills. YG says, I feel like the last 45 minutes before the closing bell when the Q&A is over is more technical. Sometimes the Q&A goes into the closing bell. It depends how many questions he takes. But yes, like I said, to me, the best edge is Powell is talking. He's answering questions. He's done with his first bit where he's just reading off, his pre-written statement, and he's answering questions. And in that time, the market is going in a direction that, you can just go back and look at the history. You'll see it tends to just keep going and going and going and going until he's done talking. So in that moment, you might know he's got another hour of answering questions. The market is going down and down and down and down. And you just got to find a way to get into a short somewhere in there. And you'll likely be able to grab 10 points or 20 points or 30 points of it. But as soon as he's done talking, well, then it's back to watching support and resistance levels and figuring out what the market is going to do next. All right, so we are now 15 minutes into the minutes coming out. 15 minutes into the minutes coming out. That's a mouthful. So this is generally where things start to kind of slow down a little bit. The tempo tends to get a little bit slower. Things tend to get a little bit more boring until 2:30, which is when they will pick up steam real quick. If you guys have any questions for me, let me know in the chat. So right now we got 32 thumbs up, but we got 85 people hanging out. So roughly 50 of you hate me. And I don't know what I ever did to you. What did I do? Let me get that like. Por favor. IAG said something and deleted it before I had a chance to read it. So my answer is no response. Jad says we're just waiting for Mr. Powell. That we are. That we are. Come on, Papa. Pete the Cat says, I hit the like button, but you're not singing today. Look, you're not gonna peer pressure me into it, okay? I'm gonna sing when the music comes. We got a few minutes to kill here until Papa Powell comes. So even though none of it will matter once he starts talking, it might be worth just taking a second to kind of assess where the market is and how we got here. I am a firm believer, for those of you that are new to the channel, I'm a firm believer that context is one of the biggest edges that you can have as a trader. So it's not just, is the market going up or down right now, but it's how did the market get to where it is right now? And what does that mean to carry forward, right? How do we use that information based on what are the likely probabilities of what happens next? So just to start off for a second, let's zoom out and we'll take a look at the daily chart just to get an idea of what the market has been doing. Okay. So the market had momentum. We were stuck in this range for a long time. Okay. And we were just kind of bouncing around, trying to break out. And we finally broke out of that range. That created momentum. That momentum took us to new all-time highs. We got a dip, and that dip was immediately bought right back up to all-time highs. That was bullish to see. So we were expecting continuation higher. But then what happened? We just went sideways, right? We just went sideways for over a week. Just kind of grinding along there at the all-time high, no real momentum. Then Trump tweeted about China, and we had this massive sell-off. Now, that sell-off was actually a good thing, which might seem strange because you would say, the market's up at all-time highs and there's this huge sell-off. Isn't that very, very bearish? Well, no, it's not, because what we did was we squeezed out the weak hands. We squeezed out the traders that were chasing price on the way up. And we gave stronger hands that buy dips, that wait for the market to come back to the previous balance area highs. We gave them a chance to get in. So those stronger hands stepped in. We had a little bit of a chaotic week, as a result of that created a lot of turmoil. It created a lot of volatility, right? And then the market tried to go lower and could not go lower. So that was where things got really interesting, because now we know where those all-time highs are. We know strong hands bought the dip, not once, but twice. So what do we assume the market is going to do? It's going to head back up to those all-time highs again, right? And that is what it did. Came back up to those all-time highs. But this is where it gets wonky, okay? Once it got to those all-time highs, it just took off straight to the upside. So what is this up here? This is chasing price. That's what this is. This is people that were thinking that the market needed to have a bigger pullback, suddenly being forced to change their mind. If they were short the market, they got stopped out. If they were flat, they had to chase the long side, right? And so now we're back in a similar position as we were in here, right? Where the market has momentum up, it's making new all-time highs, but we are built on a house of sand right now. This is weak hands that have taken this market up here. So what this market really needs is another one of these. We need another big flush. Let's squeeze out all the weak hands that have chased the market up and give the stronger hands a chance to step in. And so do you say, okay, cool, Charles, so you're shorting the market, right? Well, no, of course not. Because FOMO and short covering, which is what we're getting here this week, FOMO and short covering is momentum. It is momentum that will run out very quickly, meaning once it's over, it will instantly reverse itself. But it is still momentum, and we don't fight momentum, right? That is a really important concept, is that as long as we keep making higher highs, and higher lows on the daily, we should assume the next day can make a higher high and a higher low. And if it does, we should assume the next day can make a higher high and a higher low. We should not change our mind about momentum until the market generated information tells us the momentum is over. So what is that? Making a lower low on the daily. Okay. So now we can zoom in and we can look at the market profile chart and we can say, what would that look like? So essentially, if today the market were to get below 69.03, or let's say this was the low for today, if tomorrow were to get below today's low, that would be the sign that we've run out of momentum. The momentum is likely over. And at that moment, you start to squeeze all those weak hand buyers. Now, at market open yesterday, I was feeling like this thing needed a pullback desperately. By market close yesterday, I had changed my mind. Why? When you have momentum, so the market is going up very far, very fast, there's two ways it can balance off momentum. One is with price, which would be that pullback that we're talking about, right? That would be a way to balance off the momentum. That gives the stronger hands a chance to get in, and you can turn around and keep going. The other way you can balance off momentum is with time. So that would be the market pushes up and then it just spends time at a higher price. And if you spend enough time at a higher price, you give those stronger hands a chance to go, oh, well, I guess I'm not going to get my dip. I'm going to have to buy up here. And that can give the market momentum higher. Well, intraday yesterday, that's what the market did. Yes, on a daily time frame, it was still making higher highs and higher lows. It was still momentum on a daily time frame, but intraday, we got a bell-shaped curve. Okay? Meaning tapering off in terms of time and volume near the highs, a majority of the time and volume of the day in the middle of the range. And also we closed almost exactly at the opening price, a half a point off. So essentially the market went nowhere. And it spent a whole day going nowhere. Well, what is it doing today? Same thing, right? The market opened at 69.42 and we were there, 10 minutes ago. So today the market is doing the same thing. It's just balancing. It's just giving us a bell-shaped curve and it's just spending time. And if the market spends enough time up here, it can just keep going up. It won't need that dip in price. Now, as soon as Papa Powell starts speaking, everything changes. And that is right now. So I'm going to go quiet while he's speaking. If there's anything that jumps out at me on the chart, I will make sure to say so. Here he comes. Here he comes to save the day.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Although some important federal government data have been delayed due to the shutdown, the public and private sector data that have remained available suggests that the outlook for employment and inflation has not changed much since our meeting in September. Conditions in the labor market appear to be gradually cooling, and inflation remains somewhat elevated. In support of our goals and in light of the balance of risks to employment and inflation, today the Federal Open Market Committee decided to lower our policy interest rate by a 0.25 percentage point. We also decided to conclude the reduction of our aggregate securities holdings as of December 1. I will have more to say about monetary policy after briefly reviewing economic developments. Available indicators suggest that economic activity has been expanding at a moderate pace. GDP rose at a 1.6% pace in the first half of the year, down from 2.4% last year. Data available prior to the shutdown show that growth in economic activity may be on a somewhat firmer trajectory than expected, primarily reflecting stronger consumer spending. Business investment in equipment and intangibles has continued to expand, while activity in the housing sector remains weak. The shutdown of the federal government will weigh on economic activity while it persists, but these effects should reverse after the shutdown ends. In the labor market, the unemployment rate remained relatively low through August. Job gains have slowed significantly since earlier in the year. A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. Although official employment data for September are delayed, available evidence suggests that both layoffs and hiring remain low, and that both households' perceptions of job availability and firms' perceptions of hiring difficulty continue to decline. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen in recent months. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index suggest that total PCE prices rose 2.8% over the 12 months.
Okay, so the market has not picked a direction yet. I'd love to know in the chat, where do you guys think we're going to go? Are we going to close with a new high above today's range? Are we going to close inside today's range? Or are we going to close with a new low? I'll give you 3 minutes to vote. Let's see what happens.
Measures of inflation expectations have moved up on balance over the course of this year on news about tariffs, as reflected in both market and survey-based measures. Beyond the next year or two or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to lower the target range for the federal funds rate by a 1/4 percentage point to 3.75% to 4%. Higher tariffs are pushing up prices in some categories of goods, resulting in higher overall inflation. A reasonable base case is that the effects on inflation will be relatively short-lived, a one-time shift in the price level. But it is also possible that the inflationary effects could instead be more persistent, and that is a risk to be assessed and managed. Our obligation is to ensure that a one-time increase in the price level does not become an ongoing inflation problem. In the near term, risks to inflation are tilted to the upside and risks to employment to the downside, a challenging situation. There is no risk-free path for policy as we navigate this tension between our employment and inflation goals. Our framework calls for us to take a balanced approach in promoting both sides of our dual mandate. With downside risks to employment having increased in recent months, the balance of risks has shifted. Accordingly, we judged it appropriate at this meeting to take another step toward a more neutral policy stance. With today's decision, we remain well positioned to respond in a timely way to potential economic developments. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. We continue to face two-sided risks. In the committee's discussions at this meeting, there were strongly differing views about how to proceed in December.
Okay, so there's your first directional pick. The market is going down. Now, fortunately, if you were feeling bullish a second ago, you had the hero line telling you not to be bullish, telling you they're buying puts here, not calls. So that was good that we didn't FOMO into any longs. Now the question is, can we short this? Is this going to keep going? If we're going to short it, we're going to squeeze our butt cheeks real tight. We're going to put our stop below our entry just as soon as we can, and we're going to take profits quick. But for now, the momentum is down, and I would say I'm bearish as long as we stay below the overnight low, 69.22. If it comes back up into the overnight range, then that's it. The momentum to the downside is over. So the new selling should happen below that overnight low, or it will have just been a liquidation.
Over the 3.5 years that we've been shrinking our balance sheet, our securities holdings have declined by $2.2 trillion. As a share of nominal GDP, our balance sheet has fallen from 35% to about 21%. In December, we'll enter the next phase of our normalization plans by holding the size of our balance sheet steady for a time, while reserve balances continue to move gradually lower as other non-reserve liabilities, such as currency, keep growing. we will continue to allow agency securities to run off our balance sheet, and will reinvest the proceeds from those securities in Treasury bills, furthering progress toward a portfolio consisting primarily of Treasury securities. This reinvestment strategy will also help move the weighted average maturity of our portfolio closer to that of the outstanding stock of Treasury securities, thus furthering the normalization of the composition of our balance sheet. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting our maximum employment, bringing our inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Okay, so as we discussed,
Chair Powell, are you?
sorry, let me mute that. As we discussed before, generally if the market's going to make a big move, it's when he starts answering questions. And the way it'll work is it'll just keep going in that direction. Okay? As long as it just keeps going and he's talking, you can assume it's going to keep going. If it reverses now, as I just said, and gets back above 69.20, then the move to the downside is over. Okay? So if the sellers want to keep this thing going down, they want to stay below that overnight low, and they want to start to just get that momentum going. This is bearish to me.
We haven't made a decision about December, and we're going to be looking at the data that we have, how that affects the outlook and the balance of risks, and I'll just say that.
You and some of your colleagues have framed last month, and maybe today, I won't put words in your mouth, there's a risk management exercise. At what point do you conclude that you've taken out enough insurance? Are you looking for some kind of improvement in the outlook, or could this unfold along the lines of last year, where you made a sequence of adjustments and then waited to gather more information?
So the way I've been thinking about it is the risks to the two goals. For a very long time, the risk was clearly of higher inflation. And then that has changed now. And as we saw particularly after the July meeting, we saw the downward revisions in job creation, we saw a very different picture of the labor market, and suggested that there were higher downside risks to the labor market than we had thought. And that suggested that policy, which we had been holding at a I would say modestly, others people would say moderately restrictive level, needed to move more in the direction over time of neutral. If the two goals are sort of equally at risk, then you ought to be at neutral, because one of them's calling for you to hike and one of them's calling for you to cut. So if that got back into balance, then you'd want to be roughly at neutral. So in that sense, it was a risk management. And I would say the same about today, sort of the same logic. But as I mentioned, going forward is a different thing.
I'm Claire Jones, Financial Times. Thank you for taking this question. We've just heard from you that the discussion in December and the conclusion of the discussion is not a foregone conclusion. I'd like to just dig into that a little bit more about what sort of arguments were brought up. Was there any consideration, for instance, of the investment we're seeing in AI and some of the generation of household wealth through rises in stock prices related to the AI boom? Thank you.
I wouldn't say that's a factor in everyone's assessment of the economy. I wouldn't say it's the driving factor. I don't think for anybody. I guess I would say it this way. Once again, I would just point out that we have the situation where the risks are to the upside for inflation and to the downside for employment.
Okay, so as we work our way lower here, 68.81 is the last week reference that we have in need of repair from the last few days. After that, we get into the old gap. So if buyers don't want this market to crash and burn here, they want to start to step in. and defend. They want to stay above 68.77. If this market gets below 68.77, it's going to start liquidating into that gap, which could cause significant selling. So the buyers want to just repair 81 and then flip in reverse. Let's see what happens.
Remarks. And that's what leads me to say that, that we haven't made a decision about December. I always say that. It's a fact that we don't make decisions in advance. But I'm saying something in addition here, is that it's not to be seen as a foregone conclusion. In fact, far from it.
Can I just ask a quick follow-up on QT? How much of the fund impressions we've seen in money markets are related to the U.S. Treasury issuing more short-term debt?
That could be one of the factors, but the reality is we've seen, the things that we've seen, higher repo rates and federal funds rate moving up. These are the very things that we look for. We actually have a framework for looking at, what the place we're trying to reach. What we said for a long time now is that when we feel like we're a little bit or a bit above what we consider a level that's ample, that we would freeze the size of the balance sheet. Of course, reserves will continue to decline from that point forward as non-reserve liabilities grow. So this happened, some things have been happening for some time now, showing a gradual tightening in money market conditions. Really in the last, call it 3 weeks or so, you've seen more significant tightening, and I think a clear assessment that we're at that place. The other thing is, the balance sheet is shrinking at a very, very slow pace now. We've reduced it by half twice. And so there's not a lot of benefit to be holding on to get the last few dollars because, again, with the balance sheets, the reserves are going to continue to shrink as non-reserves grow. So, there was support on the committee as we thought about it to go ahead with this and announce effective December 1 that we will be, freezing the size of the balance sheet. And the December 1 date gives the markets a little bit of time to adapt.
Colby. Thank you. Colby Smith with the New York Times. So much of the rationale for cutting interest rates, even as inflation moves away from the 2% target, seems to be, that there are these mounting downside risks to the labor market. But if those don't materialize and the labor market either stabilizes around current employment levels or even starts to strengthen somewhat, how would that change your perception of how much interest rates need to fall from here? Would you then be a bit more concerned about underlying inflation and the possibility of second-round effects from tariffs?
Yeah, in principle, if you were to see data that suggested that the labor market's strengthening or even that it's stabilizing, that would certainly play into our decisions going forward. So, we do have, we get some data. The labor market is a place where we get, for example, we get the state-level data on initial claims, which are sending a sort of a signal of more of the same. We also get job openings, and we'll get lots of survey data. We'll get the Beige Book and things like that. So we'll have a picture of what's going on in the labor market, and the fact that we're not seeing an uptick in claims or a downtick really in openings suggests that you're seeing maybe continued very gradual cooling, but nothing more than that. So that does give you some comfort.
But if this shutdown lasts a while longer and you don't have that data in hand, I'm just wondering how that hinders the committee's ability to assess the state of the labor market and make the right policy decisions, and also how much is that factoring into the debate about December?
Yeah. So we get like I mentioned what we get in the labor area. We get some data in inflation, some data in economic activity. And we'll have a picture of what's going on. We also will have the Beige Book again. I would say we're not going to be able to have the detailed feel of things. But I think if there were a significant or material change in the economy one way or another, I think we'd pick that up through this. So in terms of how it might affect December, it's really hard to say. December's the meeting's like a 6 week.
Okay, so for those of you that are thinking the move to the downside is over, it is not. We still have an iceberg down there, so that tells us the market wants to poke it once more, and we didn't quite clean up that last week reference. And right now, yesterday's low is acting as resistance. So if yesterday's low doesn't hold as resistance, then the down move might be over. But for now, it's still very relevant and still very possible. And we're getting that test right now.
To the discussion about, to the extent it related to December. You saw we had 2 dissents, one for 50 and one for no cut. So, that was a strong, solid vote in favor of this cut. The strongly differing views were really about the future. What does that look like? And I think people are saying, they're noticing stronger economic activity. Forecasters generally, broadly, have raised their economic growth forecasts for this year and next year, in some cases quite materially. In the meantime, we see, a labor market that's kind of, I don't want to say stable, but it's not clearly in motion. It's not clearly declining quickly in any case. It may be just continuing to gradually cool. And again, people have different forecasts and expectations about the economy and different risk tolerances. And so there's you read the SEP, you read the speeches, there are differing views on the committee, and to the point where I said what I said.
And just to follow up on the balance sheet, if you stop it, the runoff now, does that mean you have to go back to actually adding assets sometime next year so that the balance sheet doesn't shrink as a percent of GDP and become a tightening factor?
So you're right. The place we'll be on December 1 is that the size of the balance sheet is frozen. And as mortgage-backed securities mature, we'll reinvest those in Treasury bills, which will foster both a more Treasury balance sheet and also a shorter duration. So that's what, in the meantime, if you freeze the size of the balance sheet, the non-reserve liabilities, currency, for example, they're going to continue to grow organically. And because the size of the balance sheet is frozen, you have further shrinkage in reserves. And reserves is the thing that we're managing that has to be ample. So that'll happen for a time, but not a tremendously long time. We don't know exactly how long. But at a certain point, you'll want to start reserves to start gradually growing to keep up with the size of the banking system and the size of the economy. So we'll be adding reserves at a certain point, and that's the last point. Even then, we didn't make decisions about this today, but we did talk today about the composition of the balance sheet, and there's a desire that the balance sheet be right now it's got a lot more duration than the outstanding universe of Treasury securities, and we want to move to a place where we're closer to that duration. That'll take some time. We haven't made a decision about the ultimate endpoint, but we all agree that we want to move more in the direction of a balance sheet that more closely reflects the outstanding Treasuries, and that means a shorter duration balance sheet. Now, this is something that's going to take a long time and move very, very gradually. I don't think you'll notice it in market conditions, but that's the direction of things.
Janelle.
Janelle Marte with Bloomberg. How are officials interpreting the latest CPI report? So some components came in lower than expected, but core inflation was still at 3%. So at this moment,
okay, well, that tells us the move to the downside
drivers?
is likely over, and that we are now probably about to start going sideways between, let's say, 69.20 and 68.90. We're probably going to do some grinding up and down here. The tempo will remain very, very fast. The moves will remain very, very large, but I think the overall downside move is over. They repaired a lot of weak references, and they defended that low so that we didn't get back into that gap. So that implies these were some stronger hand buyers that stepped in here. Doesn't mean we can't go lower tomorrow or the next day, but for today, I think that's probably it. And now we just start ripping around, ripping up, ripping down until Powell is done talking.
That's the one that we kept expecting it to do that. Now it's been doing that for some time, and we expect to continue that. That leaves the biggest category is services other than housing services, and that's kind of been moving sideways over the last few months.
Also, lastly, I just want to mention the hero line is going to be very important for us over the next 30 minutes or so. There's a chance that we've just made a low. And so this hero line is going to start to work its way back up. But if it rolls over again and starts to work its way lower, we could get a whole nother push to the downside. So we want to see this hero line continue up if we're, not short. If we are short, we want to see that thing turn around and start going down. But as I said, I think we just made the low of the day.
So that we look at that, and the thing about tariff inflation is the base case is that it will come and it probably will increase further, but it is that it will be a one-time increase. And, we've been very focused for all of this year at making sure that that's the case and thinking carefully about what are the pathways through which it could become something else, troublesome inflation. One of those would be, a really tight labor market. We don't see that. Another could be inflation expectations moving. We don't see that. So I think, we're watching this very carefully. I think it's not the case that we're just assuming that it's going to be a one-time inflation. We understand fully that this is a risk we have to monitor and ultimately manage.
With the stubborn in services inflation, what are some of the things that the Fed could do to address that? And especially when we're seeing potentially labor supply challenges?
Sorry, say the first.
The stubborn services inflation that you mentioned.
Service inflation, yeah. Well, again, the part of services inflation that isn't coming down as we would like it to is the non-market part of non-housing services. And, overall, that's just something that we expect will come down. The non-market part of it should come down. It largely reflects higher stock prices and financial services that are imputed rather than actually paid is a big part of that. But also just, we think policy is still modestly restrictive in my telling. So that's the kind of thing that should lead to a gradually cooling economy. That's one of the reasons you see a gradually cooling labor market is because, the Fed policy is modestly restrictive. So that should also help get that. I want to say, though, we're absolutely committed to returning inflation to 2%. If you look at longer-term surveys or market pricing, you will see that's a credible commitment, and there should be no question that that's where we're going.
Chris.
Great, thank you. Chris Rugaber at Associated Press. So there's a big investment boom in AI infrastructure right now, as you know, and wondering if the existence of such a boom would indicate that rates are not that restrictive after all, and could further rate cuts at this point perhaps fuel an excess level of investment there or market bubbles? How is the Fed thinking about that?
So I don't think that you're right. There are a lot of data centers being built and other investments being made around the country and around the world. And big U.S. companies are just investing a lot of resources in thinking about how AI, which will be based on those data centers, run through those data centers, is going to affect their businesses. So it's a big deal.
Candle Swinger says, wow, it's going to be a V-shaped recovery. All right, well, for now, it's a V-shaped recovery. And I do think the low of the day is in. But if we start to turn this area, which was the lows earlier, this area around 69.30 into resistance, we can absolutely come back down and close somewhere near the lows. It's too early to say. We've got a lot of low volume nodes in here that need to be backfilled. So it might not be a V-shaped recovery. It might just be the market coming back to backfill those before turning around and coming back down. And the volatility, the speed and the size of the range is going to remain until Powell is done talking. So we could still close near the lows of the day. But for now, it's a V-shape because we found those strong hands. We're retracing to clean up the weakness we just created, and then we find out what comes next. So the auction down is over. We've begun the auction up. Doesn't mean we can't get another auction down before the end of the day. This is a gambler's market.
Book, which will be sort of come out mid-cycle as always. And it doesn't replace the government data, but it gives us a picture. Again, I think If something material were happening, if there were material developments, I think we would pick that up. I don't think we'll be able to have the very granular understanding of the economy while this data is not available.
Howard?
Howard Schneider with Reuters. Thank you. I just wanted you to elaborate a little bit on what you said a moment ago about the continued shutdown, making it more difficult to make a move in December, and that may make you more cautious. To the degree you are relying on private data that isn't the gold standard, or that you're relying on your own surveys or the beige book, do you worry at some point you're going to have to start making policy by anecdote?
This is a temporary state of affairs, and we're going to do our jobs. We're going to collect every scrap of data we can find, evaluate it, and think carefully about it, and that's our jobs. That's what we're going to do. If you ask me, could it affect the December meeting? I'm not saying it's going to, but yeah, you could imagine that what do you do if you're driving in the fog? You slow down. So that could or could not. I don't know how that's going to play into things. We may get the data may come back, but there's a possibility that it would make sense to be more cautious about moving. I'm not committing to that. I'm just saying it's certainly a possibility that you would say we really can't see, so let's slow down.
As a follow-up in the debate on this meeting, we saw recently some pretty big layoff announcements coming from Amazon and others. Wondering if that figured into the discussion at all, that you're starting to see this tension between growth and employment starting to be resolved, to the detriment of employment. And secondly, some of the stress is starting to appear in the bottom spur of the K, as they call it, household health premiums that are going to possibly be going up quite substantially, things like that. Has that started to become a factor in your policy discussion?
So those are both things that we're watching very, very, very carefully. To start with the layoffs, you're right. You see a significant number of companies either announcing that they are not going to be doing much hiring or actually doing layoffs, and much of the time they're talking about AI and what it can do. So we're watching that very carefully. And yes, it could absolutely have implications for job creation. We don't really see it in the initial claims data yet. Now, it's not a surprise that we don't. It takes some time for it to get in there, but we're watching that really carefully. But again, don't see it yet in the initial claims data. On the K-shaped economy thing, I would say the same thing or similar thing. We are. If you listen to the earnings calls or the reports of, big public consumer-facing companies, many of them are saying that there's a bifurcated economy there, and that consumers at the lower end are struggling and buying less and shifting to lower-cost products, but that at the top, people are spending at the higher income and wealth, and so much. Anecdotal data on that, and so we think there's something there.
Edward.
Thank you, Edward Lawrence with Fox Business. So, Mr. Chairman, I want to take another crack at the further reduction of rates is not a foregone conclusion. So in December, you said far from it. So if a cut might not be on the table for December because of lack of data, what does the other concerns then stem from? So if it's not lack of data as the reason December is not a foregone conclusion, what other things could be the concern then? Well,
the perspectives of people on the committee that, we've now moved 150 basis points, and that we're down into, you're into that range between 3 and 4 where many estimates of the neutral rate live in that 3 to 4% area. You're there now. You're above the median number for the committee, but I think there are people on the committee who have higher estimates of the neutral rate, and that's you can argue these positions since it can't be directly observed, the neutral rate. So, I think for some part of the committee, it's time to maybe take a step back and see whether there really are downside risks to the labor market, or see whether in fact the growth that the stronger growth that we're seeing is real. Ordinarily, the labor market is a better indicator of the momentum of the economy than the spending data. That's the lore. In this case, that gives a more downbeat read. So people just have, again, we've cut 50 more basis points in the last two meetings, and there was a sense like, from some, let's pause here, kind of thing, and a sense from others wanting to go ahead. But that's why I say differing views, strongly differing views.
And so on that division, then you're talking about going forward. So what's more important in this division? Is it inflation risks? Is it employment risk? Or is there a deeper philosophy division among the board?
Look, everybody on the committee is deeply committed to doing the right thing to achieve our goals, maximum employment and stable prices. You have differences on how to do that. And as I mentioned, some of that is different forecasts, but a lot of it is also different risk aversions to the different variables, which is common through all Federal Reserves. People just have different risk tolerances, let's say. So that leads you to people with disparate views. You will know that from the speeches you've been listening to from my colleagues. And so we're at a place now where we have, in fact, cut 2 more times. And, we're 150 basis points closer to neutral, wherever that may be, than we were a year ago. And so there's a growing chorus now of feeling like maybe this is where we should at least wait a cycle, something like that. That's what it is. It's just what you think it would be. It's and again, you've seen it in the September Summer of Economic Projections. You've seen this in the public remarks of FOMC participants, and now I'm telling you that's what you can expect that in the minutes. And I'm just telling you that's what happened in the meeting.
Elizabeth. Thank you so much. Elizabeth Schulze with ABC News. What is your explanation for why the job market is weakening right now, and what will this rate cut do to improve the job market?
So I think there are 2 things affecting the job market, and one of them is just a dramatic reduction in the supply of new workers. And that's 2 things. That's declining labor force participation, which is a cyclical thing. And then there's declining immigration, which is just a big policy change that actually began in the last administration and has been accelerated now. So a big part of the whole story is that supply side story. Okay. In addition, labor demand has declined, and the unemployment rate has gone down, meaning that demand for workers has gone down a little more than supply. So that's what's going on, but it is mostly a supply function. It's mostly a function of the change in supply, I think, and many people think. So the question then is, what does the our tool do, which supports demand, and and I would just say, when you're in a situation where job creation, if you adjust for likely overcounting in the way that BLS does its work, is pretty close to 0. So maximum employment doesn't, on a sustainable basis, if you're creating 0 jobs, if it's in equilibrium, if it's in balance, it's a pretty, as I said before, a pretty curious balance. So, I thought, and many of my colleagues thought, in fact, you've seen the last 2 meetings, that it was appropriate for us to react by supporting demand with our rates. And we've done that. We've reduced so that rates are looser. I wouldn't say that they're accommodative right now, but they're meaningfully less tight than they were. And that should help so that at least the labor market doesn't get worse. So it's a complicated situation, and some people argue that this is supply and we really can't affect it much with our tools, but others argue, as I do, that there is an effect from demand and that we should use our tools to support the labor market when we see this happening.
You also talked about tariffs causing a one-time price increase. Should American household consumers expect that inflation will continue to go up this year because of those tariffs?
So the basic expectation is that there will be some additional increase in inflation because it takes a while for tariffs to work their way through the production chain and finally get to consumers. And we see this now from the tariffs that were put in place now many months ago. We see those effects, but if you put tariffs in effect, and they've been coming into effect consistently in February, March, April, May, And that's all happening. So that'll continue to happen for some time, probably into the spring. These are not big increases, though. These are a tenth or so on inflation. They may be big increases on a particular product that's been tariffed, but overall, these are fairly modest. I think, some projections go, we're at 2.8% inflation. You might get 2 or 3 more tenths or 4 more tenths maybe. But then, as all of the tariffs are in, they stop generating inflation. You've had a one-time price increase. As long as you're not, at least this is the theory, this is how we believe and hope that it will work out. Once the last tariff is put on something, at that point, it becomes a higher price level, but it stops going up, if you will. Prices stop going up. They'll just be at that level. And then measured inflation will come back down to non-tariff inflation. As I mentioned, non-tariff inflation is not so far from 2% now. Now, consumers are not interested in that story. Their prices are higher. More than that, the reason they're so unhappy about inflation is the inflation that we had in 2021, 2, and 3. Because, you can say that prices aren't going up as much, but that doesn't mean people aren't feeling those higher prices from the inflation we had 2 or 3 years ago. They are, and that's, I think, a large part of why the public, if you sample people, inflation is still very much making people quite unhappy. Even, and it's nice that, that prices are not going up as fast as they were, but they're still much higher than they were. And it'll take some time for that effect to wear off. As real incomes rise, it will feel better over time, but that's going to take time.
Michael Pickey from Bloomberg Television and Radio. Do you have any concerns that equity markets are or are close to being overvalued at this point?
We don't look at any one asset price and say, hey, that's wrong. It's not our job to do that. We look at the overall financial system, and we ask whether it's stable, whether it could withstand shocks, right? So, banks are well capitalized, while some households are clearly under stress. In the aggregate, households are in good shape financially, relatively manageable levels of debt. At the lower income spectrum, you are seeing rising defaults, particularly around subprime auto, but nonetheless, in the aggregate, pretty good. You don't see too much leverage in the banking system or the financial system. It's a mixed picture, but it's not an overly troubling picture. And again, I'm not. It's not appropriate. We don't set asset prices. Markets do that.
Well, you must be well aware that by lowering interest rates, you're contributing to additional asset price increases. And I wonder how you balance the idea that lowering rates would help the labor market with the reality that it seems more likely to be stimulating increased investment in AI, which is the rationale for thousands of job cuts that have been announced in the last few weeks.
Yeah, I don't think interest rates are an important part of the AI of the data center story. I think people think they're great economics in building these data centers, and they're making a lot of money building them, and they think they have very high present value and all that sort of thing. It's not really about about 25 basis points here or there. We use our tools to support the labor market and to create price stability. That's what we do. That's our two jobs, right? So we're here by lowering rates at the margin, that will support demand, and that will support more hiring, and that's why we do it. Now, no 25 basis point or even 50 basis point hike is going to be a dispositive thing, but ultimately, lower rates will support more demand, and that'll support hiring over time. And of course, we also have to be careful about this, which is what we've been doing, because we know where inflation is, and we know that, I've told you the story. It's a complicated story, but this is the best assessment that we can make. Because there's uncertainty around inflation and the path ahead for inflation, that's why we're going. That's why the pace we're going has been a careful one.
Victoria. Hi, Victoria Guida from Politico. On AI, I'm just wondering, it seems like a lot of the economic growth that we've been seeing is fed by investments in AI. So how worried are you about what a sudden contraction in tech investment would mean for the overall economy? Is there enough strength in other sectors? And specifically, are there any lessons that you take from the 1990s in how you might approach what's happening right now?
Yeah, this is different in the sense that these companies, the companies that are so highly valued, actually have earnings and stuff like that. So if you go back to the 90s and the dot-com, these were ideas rather than companies, and so there's a clear bubble there. Whereas I won't go into particular names, but they actually have earnings, and it looks like they have business models and profits and that kind of thing. So it's really a different thing. The investment we're getting in equipment and all those things that go into creating data centers and feeding the AI, it's clearly one of the big sources of growth in the economy. Consumer spending also, though, has been, is much bigger than that and has been growing and has defied a lot of, negative forecasts, continuing to do so this year. Consumers are still spending. Now, it may be mostly higher-end consumers or maybe skewed that way. But the consumer is spending, and that's a big, big chunk of what's going on in the economy, substantially bigger than AI. You could point to growth. I mean, actually, growth as opposed to level, but consumer spending is a much bigger part of the economy.
And why do you think that the labor market is slowing so much, even though consumer spending is strong?
Why has it slowed so much? Well, what's happened is that the supply of workers has dropped very, very sharply due to mainly immigration, but also lower labor force participation. So, and that means there's less need for new jobs because there isn't this flow into the pool of labor that, where people need jobs, because there aren't those people now. So there's not a supply of workers showing up for jobs. In addition, demand has also gone down, and so has labor force participation has declined, which is more of a sign, in this case, of demand as well as trend. So I think you're seeing some softening. The economy's growing at a slower rate than it was, 2.4% last year. We think around 1.6% this year. It could have been a couple of tenths higher if not for the shutdown. And of course, that will reverse. But, you still got the economy growing at a moderate pace.
Andrew.
Hey there, Andrew Ackerman with the with the Washington Post. I wanted to ask if you could elaborate on how you think about policy in the context of the data drought. Does it make you inclined to stick with your plans as set out in September in the absence of the data that might change your mind, or does it make you inclined to proceed with added caution because of uncertainty?
Yeah, well, we'll know when we face that question, if we face that question. It'll probably be argued both ways, right? But I've said a couple times here that, if you really aren't getting information you really don't know, and the economy looks like it's solid and stable and hasn't really changed, there will be an argument. I don't know how persuasive it will be, but there will be an argument that, you slow down when you can't see as far ahead. Others may argue, I'm not sure where this argument will come, but you're perfectly right that you could also argue, well, things haven't really changed, but you might not know that, So I don't know whether we'll face this or not. I hope we don't. I hope by the time of the December meeting we're getting, a better flow of data. But if we're going to have to do our jobs one way or the other.
Okay. I also just wanted to ask a FinReg question. I think several years ago you said the overall amount of capital in the system was about right. As the Fed moves forward with a revised Basel proposal, potentially changes to the GSIB surcharge, has that changed at all? Or are you planning to significantly reduce the amount of capital in the system? Thanks.
So there are discussions going on, I think, among the agencies, and I don't want to get ahead of those discussions. I continue to think that the level of capital, when I said that in 2020, was about right. And of course, there's been much capital added since then through various mechanisms. But I look forward to I know those discussions are really just getting going. They haven't come to the point where they're got a whole plan and that kind of thing. So I really don't have much to say on that.
Brian.
Hi, Chairman Powell. Brian Chung with NBC News. Is the weakness in the jobs market accelerating? And who's at risk if the interest rate cuts are not the effective medicine for a further slowdown in the labor
So
market?
we do not see the weakness, as you put it, the weakness in the job market accelerating. I would say, then again, we didn't get the September employment report, payroll report, but we look at, the unemployment insurance claims, initial claims are reported at the state level, and we still get those, and we can accumulate them and get the national number. And there's really, no story. You can look at the numbers. Same thing with the job openings we get from Indeed. There's just no story over the last 4 weeks. It's kind of stable. So you don't see anything that says that the job market is, or really any part of the economy is making a significant deterioration. Don't see that. You see more things like I mentioned, though, which is you see big companies making announcements of either of layoffs or of the idea that they won't need to hire. Their number of employees is not expected to go up over a number of years. There may be different people working there. They say that too, but they don't need a bigger head count. So you see those kinds of things. You don't see it in the aggregate numbers. The layoff numbers have not gone up, but job creation is very low. And the job finding rate for people who are unemployed is very low. But the unemployment rate is very low as well. 4.3% is a low unemployment rate.
So as you make these cuts, is it the lower income workers that you're thinking about, or those who might have their jobs automated? Is there a particular
That we're
section
thinking
of the
of?
labor market that you're particularly?
So we can't, our tools don't allow us to target any demographic or any income level and that kind of thing. I do think that people, we saw this during the global financial crisis and the long recovery. If you have a long period of very strong labor market conditions, it benefits people at the lower end the most. The last 2 or 3 years of that long expansion, people at the lower part of the income spectrum were getting the biggest benefits, and lots of things were happening in that space demographically, which were very constructive. And we're not at that place right now. But so, yeah, a stronger labor market is the best thing we can do for the public. It's also part of our job. It is half of our job, but it is absolutely the best thing we can do for people. Along with keeping prices stable. Those two things. Inflation also hurts people on fixed incomes more than other people.
Courtney. Hi, Chair Powell. Courtney Brown from Axios. As you know, the 12 Reserve Bank presidents' terms are up for renewal at the end of February. I'm wondering if you can give us a timeline for when the board will consider those reappointments and whether we can expect everyone to be re-upped or if we can expect some changes.
So it's a process that we go through under the law. The way the law works is we have a reappointment process every 5 years for all of the reserve, each of them and all of them. We're in the middle of that process, and we're going to complete it in a timely way. And that's really all I can say.
Okay, thank you.
Daniel.
Daniel Davis, Agence France Presse. You've now had dissents in 3 consecutive FOMC meetings, but in this meeting you had dissents going in both directions, and you've just mentioned there's strong disagreement over the future path of rate cuts. Have these disagreements complicated your role presiding over the FOMC meetings, and if so, how?
I wouldn't say that, no. I think you have to take what comes, and what comes right now is pretty challenging situation where we have, first of all, we have 4.3% unemployment. We have an economy that's growing close to 2%. So, overall, it's a good picture. It's a good picture. But in terms of our policy, we have upside risks to inflation, downside risks to employment, and this is a very difficult thing for a central bank because, one of those calls for rates to be lower, one calls for rates to be higher. We can't do both, so we have to balance the two. And so it's a challenging thing, and as we have worked our way through this process, you would expect that there would be a range of views across the committee on what to do and the speed with which we should do it. And that's what we have. That makes a lot of sense to me. All of these people are, people who take their jobs very seriously, work very hard at this, and just want to do what's right for the American people, but they have different views on what that is. And, it's an honor to work among people who care that much. It is, but I don't feel that it's unfair or anything like that. It's a time when we're making quite difficult judgments in real time, and I believe we'll get through this, and I think we've done sort of the right thing so far this year. I think it was appropriate for us to be careful about this. I think it would not be appropriate to just ignore or assume away the inflation issue. At the same time, I think the risk of higher, more persistent inflation has declined significantly since April. And if we do wind up resuming rate cuts at some point, we will at some point. I think we're trying to get to the end of this cycle with the labor market in a good place and with inflation, on its way to 2% or at 2%. So that's all we're trying to do, and we're doing it under, quite challenging circumstances and doing the best we can.
We'll go to Jennifer for the last question.
Thank you so much, Chair Powell. Jennifer Schonberger with Yahoo Finance. Both regional and large banks have taken losses on loans given delinquencies on subprime auto loans. JP Morgan CEO Jamie Dimon warned, when you see one cockroach, there may be more likely. I'm curious how the Fed is looking at these loan losses and if it poses risks to the financial system or the outlook for the economy. Is it a warning sign?
So, we're obviously, we watch these things very carefully, credit conditions very carefully. You're right. You've seen rising defaults in subprime credit for some time now, and now you've seen a number of subprime credit, automobile credit institutions having significant losses, and some of those losses are now showing up on the books of banks. We're looking at it carefully. We're paying close attention. I don't see at this point a broader credit issue. It doesn't seem to be something that has very broad application across financial institutions. But we're going to be monitoring this quite carefully and making sure that is the case.
And then separately, many, you yourself have said that we're in a bifurcated economy right now with high net worth individuals continuing to spend with the lower income pulling back. How much of consumer spending continuing hinges on the stock market remaining strong? In some odd way, does the market help keep the economy buoyant?
So there's some relationship there, but remember, the more wealth someone has, the lower an additional dollar of wealth matters. So your marginal propensity to consume declines quite dramatically as you reach levels of stock market wealth. So, the stock market, it would affect spending if the stock market went down, but it wouldn't drop sharply unless there were quite a sharp drop in the stock market. People at the lower end of income and wealth have a much higher marginal propensity to consume of an incremental dollar of income or wealth, but they don't have the stock market wealth. So I think it's certainly a factor supporting consumption right now. But you would see it if you saw a material correction in spending, but it wouldn't be. You shouldn't think that it'll dollar for dollar stop consumption, because that wouldn't be the case. Thanks very much.
All right. Well, there you have it, folks. It's bullish. Okay, so we got a question here. Why is the K high considered weak? It is considered weak because it is the same place as the G, H, and D period highs. So that basically just implies that somebody who went short there probably has their stops above there. And so sooner or later, the market's going to come back up and take out those stops. Same thing with the high of the day, by the way. So what are we going to do with this information that the market just gave us? How are we going to read this? Well, unfortunately, I would have loved to clean up that last week references to feel a little more confident. But all in all, I see this as very bullish that this happened today. Why? Because before Powell came out to start speaking, I was talking about the fact that the way we got up here was weak hands chasing price. Okay? And that we would need some sort of liquidation to allow stronger hands to step in. what I meant by liquidation was much more like filling the gap, much more like getting down towards 68.41 or even as far as 67.86. So this is not that. This is not balance with price in that same way that I was talking about. But you know what this is? Balance with time. So the fact that we didn't break the low from 2 days ago is a sign that we are just going sideways at higher prices. So that's not bullish enough to say, hey, listen, tomorrow we're going to start making new all-time highs again. But it is bullish enough to say you don't want to be short this market for continuation lower. And then pretty much today's range will be the directional choice. So again, it's really hard to predict the future far in advance. But I think what's going to happen is, we got about 30 minutes till the close. I think we're probably going to close in the lower end of today's range. Okay. And then I think we're probably going to open somewhere around the middle of today's range tomorrow. And so it'll be balance as long as we're inside today's range. But when we get above today's high, that's a green light for continuation to the upside. And if we were to break today's low tomorrow or the next day, then you'd be set up for that big liquidation, right? Then you'd be looking at that daily chart and you'd be thinking that market needs that larger pullback if we got below today's low. So as a swing trader, I'm basically just bullish above today's low in the subsequent days ahead. I also think we may be in for a few days of balance like this right here, where we just kind of go sideways probably until like Monday. We may just be kind of stuck inside today as one big candle. We may spend a couple of days inside of here. And it happens. You know what I mean? Like this right here. We spent basically 3 days inside that candle. We can do that here. So swing trading, it's bullish. Day trading, it's setting us up for a choppy couple of days. And we'll take what we get. We'll take whatever the market gives us because that's the only choice we have. With that, I will say goodbye. Thank you guys very much. This was a fun FOMC. I was very, very worried before Powell came out that this might be a boring one. And it was not. So that's always to be enjoyed. All right, guys. If you are a member of the Pirate Traders Brigade, we will see you tomorrow morning in the live stream. If you are not, why not? You should come hang out. We have a lot of fun.